The U.S. dollar soaring to a series of 12-month highs today against the euro over fears here that the worst is not over for Greece and that there could be more to come. Here to help make sense of the volatility in the global currency market and what it all means for the U.S. dollar, we have David Malpass, president of Encima Global. He's also running for a U.S. Senate seat, hoping to represent the state of New York. Jeff Kleintop is the chief market strategist with LPL Financial, which manages more than $280 billion in assets. Also, Eck Managing Director of Eck G-175 Strategies, who oversees $3 billion in emerging market assets. Certainly an incredibly qualified panel, along with my co-host here for the hour, Jim Cramer. I'm going to begin there with David. What's your sense on where the U.S. dollar is headed? Is it going to continue to gain against the euro as these problems potentially worsen for Europe?
Hi, Trish. Hi, Jim. I think it can. It depends on how Europe resolves some of these problems. I do think it is the Europe weakness that's pushing the dollar up, not particularly dollar strength. We've got good growth in the U.S. going, and that's going to be an underpinning for the dollar, so I can see it going some stronger here.
Let me ask you something, David. First of all, I think it's great that you're running because it will be the most intelligent guy who's run in, well, at least recent history. There's probably somebody back there, I don't remember. But what I worry about, David, is this.
David.
I'm sitting there listening to all these conference calls that have happened in April, and many of the companies were forecasting a particular level to the euro, which would make it so that the headwinds were bad but not tsunami-like. When you get this kind of decline, then you really have to redo your estimates. How much do you think we should be worried about that just the dollar is going to be so strong that our companies are going to have shortfalls across the board that sell into Europe?
I agree that we will see earnings shortfalls from the currency translation. But on the other hand, I think what we're seeing is better growth in the U.S. economy, and so you'll see better top-line sales. So from the standpoint of an equity value, it's more valuable, I think, even though you might take some translation hits.
I think that's so right. That's so right.
You know, Jeff, we've heard a lot of folks say that given that there's so much uncertainty, so much concern in Europe right now, surrounding the currencies, surrounding the debt, surrounding the equities markets there, a lot of money we might see in the foreseeable future start to pour into the U.S. We're clearly seeing evidence of that when it comes to the U.S. dollar. Do you think it might be a trend that reaches more than just the currency?
Well, I think so. We are seeing money coming from overseas, right? I mean, the buying that's taken place over the course of the last year has not really been the U.S. investor. It's really been the foreign investor, whether it's been sovereign wealth funds or institutions or individual overseas. They've been pouring money into the U.S. and buying our equities. I think that's likely to continue. Europe, you know, we're dramatically underweight Europe. We have basically no exposure there and continue to emphasize the U.S. for a variety of reasons we've just talked about. I think European investors see that same safe haven aspect to the U.S. markets, and as David said, better economic growth to boot, and those combined to, I think, probably continue that flow of dollars or currencies into the U.S.
Eric Fine, Eck Global Managing Director. One of the things I was talking about with my friend Larry Kudlow last week when we were doing our mammoth coverage about the investigations in the Senate was that there is a lot of belief that we were beginning to see such a strong recovery in America. He uses the V term. I'm still going with a U. That we will see tax receipts go up and our deficit be the exact opposite of what you see in Greece and Spain. Is it too optimistic to think that maybe we are not going to be part of the parade of horribles, but will actually be part of the positives of the second half of 2010?
I think it matters. I think it depends on what your investment horizon is. I think if you're talking over the next few days or weeks, I think this crisis has skipped the wheels. It's not about Greece. It's a Eurozone crisis. And fair or not, all asset prices are going to get dragged into it. However, I do think your broader point is important as people watch this crisis to keep in mind. The U.S. is, for all its problems, and I'm not going to take the other side of what those problems are. They're pretty well distributed, but they're very different than what's going on in Europe. And you know, euro is becoming more clearly a currency without a country, and the U.S. doesn't have that issue. And so, so I think in the near term, all asset prices are really going to trade one variable, which is this Eurozone crisis. But broadly speaking, after this, and I do think this sort of crisis phase can't continue at this pace. So there will have to be some resolution to it. At which point, I think your point is.
I want to jump in there. What do you see as that resolution? What might that look like?
Yep, I think that's the critical question. if I had to give one simple answer, and it's a little simpler than it was a few weeks ago, which is why I think you need to be especially nimble, it's quantitative easing. True quantitative easing, the way the U.S. did, actually buying bonds, the ECB actually buying bonds, as opposed to this repo window, which isn't working. You have debt, you have T-bills, right, issued by Greece, which can be repoed to the ECB for 100 euros for at their issue price, and they're not trading at 100 cents. So clearly, confidence is broken, and so something more dramatic needs to be said. So one word or one phrase would be quantitative easing is what proper, true quantitative easing is what stops this.
David Malpass, have you heard this the German solution that we've been hearing about, which is the notion of, which is really a nuclear solution, which is that we just let things happen and see what occurs, you know, because that to me reminds me of the 80s where we let things happen with Argentina, we let things happen with Brazil. Is that on the table?
I think that it's still unresolved whether creditors are going to have to take some of the pain. Right now, Greece is raising the value-added tax on Greek people to 25% in order to pay the bonds all back in full to 90% of those bonds are owned outside of Greece. And so you wonder about the fairness equation. That same issue is going to come to the U.S., where we have a similar situation in some of the states where they've borrowed too much. And so where's the fairness come down between the people, the private sector, the government sector, and the creditors in trying to resolve some of these overreaching debts that are out there?
Yeah, and it certainly makes it hard to grow the economy in a time when you're just upping tax rates
25%
like that.
value added. I mean, it's go barter, right? We just go completely barter. We go peanut butter and jelly.
And that's a real problem, too, because
gyro.
You've got probably you've got a major Greek trade union strike starting tomorrow. You've got, they don't want these sort of the medicine's worse than the illness as they see it. And so you've got a number of things that could still derail the effectiveness of Greece to implement the mandates associated with this bailout plan.
But we always forget that in the early 80s, when I was at Goldman Sachs, oh my God, why he really worked there? You saw a tremendous. I mean, we said 90. Look, I want to go back. In other words, I want to predate 96, 97. In the early 80s, when Latin America was falling apart, we began the great bull market here. So one of the things I want to remind people is the whole time Greece was falling apart, we had one of the greatest moves in American history. So I do not want to constantly join the parade with I call it the buffet of horribles of these countries where when I should be shaking and worrying about Spain. Well, just a second. If I shook and worried about Greece, I would have sold our market at 9,000. I actually like to catch those 2,000 Dow points. So let's not get too negative.
Jim, can I add one on that point? So if a country changes for the better in its structural outlook, if it shows that it can control spending on the government, for example, then capital does come back to that country. Yes. And so you get there is a bit of a positive response, or sometimes a notable positive response from markets if a country moves in the right direction. I think the problem Greece is having is the IMF prescribed a program that you can look at and say, boy, I wouldn't want that to happen to my private sector. In this case, Greece's private sector is getting hammered, and so the market's not reacting well to that at all.
Okay, we're going to leave it there. Thanks to
I'm changing registration in New York. I get me. Throwing the vote there. I'm sorry, I was way out of line with it.
That was a great endorsement for David. Hey, David, thanks for joining us. Jeff.
Thank you.